Two countries, two stock exchanges, one invisible hand pulling the strings. Guess who? Yup, China. From railroads to deep sea ports, China's Belt and Road Initiative is transforming landscapes. But there is another front where Beijing is quietly gaining control. Stock exchanges, yes, the heart of a country's financial system. Let's head to Karachi and Dhaka, not your usual financial giants, but suddenly they have got something in common. China owns a chunk of both of the stock exchanges. In 2016, China's Shanghai Stock Exchange and Shenzhen Stock Exchange together bought a 40% stake in the Pakistan Stock Exchange. And in 2018, China's Shanghai Stock Exchange snapped up a 25% stake in the Dhaka Stock Exchange. Coincidence? That's cute. This is strategy, not charity. It was not just a cash deal, it was symbolic. China did not just want to fund infrastructure in Pakistan under CPEC, it wanted a hand-on in the economic control panel. By owning pieces of these exchanges, China is not just buying shares, it's buying influence. Access to financial data? Check. Visibility into investor behavior? Check. Ability to push, shut in financial products? Double check. Today, that stake allows Beijing to influence technology upgrades, governance policies, and trading norms. Fast forward to 2018, Dhaka Stock Exchange, the beating heart of Bangladesh finance sector, was up for modernization. A fierce bidding war erupted between China and India. Despite India's strong political ties with Dhaka, China's consortium, again led by Shanghai and Shenzhen stock exchanges, won with a higher bid and better tech promises. Why stock exchanges? Why does China want a piece of these markets? China holds no significant stake in major Western exchanges like NYSE, LSE or Deutsche Börse, but in weaker aid-dependent economics, influence is easier. Both Pakistan and Bangladesh have rising debt owed to China. In Pakistan's case, over $30 billion linked to CPEC. Stock exchanges control capital flow, the oxygen of any economy. By investing in exchanges, China gains early access to financial data, influences listing rules for Chinese companies, promotes yuan-based trade settlements, builds soft power without deploying troops. And it aligns perfectly with Beijing's larger plan, turning the yuan into global reserve currency. How are Pakistan and Bangladesh benefiting out of it? Well, they say it's about technology transfer and increased liquidity. Sounds nice, right? Except the stock exchanges in both countries are still struggling. Liquidity has not exactly exploded. Governance transparency still patchy. So what did they really get? A new investor who also wants a say in how your economy ticks? India watching closely. India of course is watching this drama unfold from the sidelines like that one neighbor who knows the whole colony's secrets. This Chinese stakes in key financial institutions right in India's backyard are not just economic news, they are geopolitical chess moves, and no one is missing the symbolism. China is slowly turning South Asia's economic architecture into a puppet show. India, the US, and strategic analysts have raised alarms. Stock exchanges are not just markets, they are critical infrastructure. China's presence could lead to data vulnerability, policy manipulation, financial dependence in crisis situations. Pakistan and Bangladesh see this as progress, but critics call it debt diplomacy 2.0, this time through equity and code. In a world where wars are fought with algorithms and contracts, control of a stock exchange can be more powerful than a military base. So the next time someone tells you stock markets are free, open and driven, while local investors remind them to check the fine print. Because in South Asia, even your stock ticker might be coming from Beijing. If you want key facts about the acquisitions, please see the description. Let us know your thoughts in the comments. Should countries allow foreign states to own key parts of the stock markets? Thank you.